Good evening, everybody. Welcome to the session tonight. Hope you're good. Delighted to see you here, of course. Thank you for all of you who popped in today. I hope it's going to be interesting, useful to add to your stuff. So let's get things kicked off at Portfolio Thinking. You should see this title slide in front of you now. And I've called it the Sentinel approach. Some of you have been exposed to some of the Sentinel work that we've done already that ultimately will be put into some of the EAs that we run. But there is a discretionary version as well, which is online and ready to go. It just needs populated with some fuller interventions. And when that's done, I'll let you know. So really what we're trying to do with Portfolio Thinking is stop thinking trade by trade. That's not to say that's not important. It's just to say that this is really another layer of risk management and potential opportunity management, of course, that if you look at what your whole book is doing, then you're probably in a better way to make some decisions. When we talk about portfolios, we often refer to them as books. And really what we're trying to do here, and I'm going to cover in this session, is to understand the role of correlation in terms of portfolio management, exposure you have, and managing book level risk, and then start to make decisions at the portfolio level, not chart level only. Although, as I've said before, it is vitally important that you do so trade by trade. So that's super important, of course. What I've done is I've put together a little self-assessment, again, which is going to be posted in the Discord channel on day 3. So I'm going to post the recording of this video and this tool for you to have a look at. And hopefully that will help you in terms of starting to think in such ways. And what I'll do is I'll take you through a little exercise. Here's the problem. Well, the trap is when you just look at trade by trade thinking is every trade is judged in isolation. So win is a good trade, loss is a bad trade, no bigger picture stuff. So though it's right to look at each individual trade, to do so solely is where the problem often lies with people. When you do trade by trade thinking, your chart is the whole world. So setup quality is the only question ever asked. And of course, in the market versus strategy video that's been assigned to day 1, we talk a little bit more about that, about looking perhaps bigger picture at the way the market is and how that relates to strategy. But also, of course, in terms of this one, we need to ask more questions than setup quality when we're looking at a portfolio as a whole. When you adopt trade by trade thinking alone, we're not looking at all of the concept of what trades add up to. So 5 open positions essentially are treated as 5 separate stories, even though, as we're going to talk about in a little while, they may be actually telling the same story, which may be to your detriment if the market moves in particular ways. And also, of course, what we're doing when we're trade by trade thinking is we'll adopt a 1%. Let's give it 1% of our equity on every trade. So trade 1 might have 1%, trade 2 with 1%, trade 3 1%, without actually looking at the total in terms of what may move together and how they move. So really what we're talking about today is trying to overcome some of these issues and start to look at what you actually have is a book. So you're running a portfolio, whether you're meant to or not. The moment you hold more than one position or trade more than one market, you have a portfolio. So your overall profit loss is the sum of the book, not the sum of your best trades. The book behaves as one thing with its own exposure, its own risk, and its own worst day and its own good day. And that's where we want to shift the thinking a little. Not exclusively, of course, as I've already said, individual trades are important, but have that as part of your thinking. And it isn't hard. It's just a case of restructuring the way you think. It should only take a couple of minutes max to make this judgment. So if we take 4 positions, for example, long Aussie USD, long gold, short USD yen, and long the US 500 or S&P 500 or whatever symbol is given to that, then essentially, in terms of how these will move, they're going to be the same way. So that's what we need to be careful of. So if we have 1% risk per trade and they all move against us because of a single market move, then that's a 4% risk, not a 1% on each trade. So two traders have the same view, very similar conviction, but very different risks. So trader A does that sort of combination that we've just sort of highlighted. And although these are four independent trading ideas taken off four different charts, they're actually one giant short USD bet at full size, 4 times over. Whereas trader B has the same overall short USD view expressed once with roughly half the correlated exposure. So what's happened here is we have a long Aussie dollar US, we've got half a long gold, and we've got a short US yen, also half the size. We've skipped the Kiwi USD, but together these have got half the correlated exposure, which means half the risk. So even though we've sort of looking at the same trades with the same view and at the same charts, a market move is going to hurt trader A badly compared to trader B. And so when we're looking at portfolio, a key point is that correlation is all about things that move together are the same trade, just with a different instrument title, unless there's a deviation from what is the normal correlation between assets. So what you don't need is a degree in math to work this out. You just need to have an awareness of the clusters. So what are the shared currencies? So Aussie US, US yen, Aussie US, Kiwi US, Euro US, GB pound US are all one USD position. If the USD goes up, then if you long these will all be bad. The indices is the equity block. The S&P, the DAX, and the NASDAQ are all risk on together and all risk off together, even though they move in different ways. Obviously, the NASDAQ is a lot more volatile, and when things are going well, tends to go better than the rest. When things are going badly, tends to go worse than the rest. Then there's the S&P 500. Then there's the DAX. Now, obviously, so just be aware of that. When you look at commodity currencies, then gold is correlated to a fairly large degree with the Aussie dollar, oil with the Canadian dollar. So the commodity drags the currency one way or the other. So if you're short Euro Aussie and you're long gold, then essentially they're the same thing. Obviously, you can trade gold Aussie, so which is probably purer if you're wanting to make that play. And then there's the general risk on, risk off. So there are more clusters available. These are the top 4 that I want you to focus on really and think about in your trading. Now, for those of you who trade shares, it's exactly the same deal. But with shares, obviously, the correlation is often sector related. So it's often easier to sort of pick. So that's worth referencing, of course. So if we look at exposure, what are you really long? Net it out. They often once you actually sort of work it out, and that's one of the things that's in the handout I've got for you today. That long Euro US plus short Euro Yen plus long GB pound US, you net it out. So what's your true Euro and USD position? Look at asset class exposure. 3 index CFDs across 3 countries is still one equity bet. We've talked about that. And also you want to have a look at directional theme exposure. How much of your book only pays if risk on continues or risk off continues, depending on how you position yourself. That's your real position. So once you've done that, there's 2 things that raises. First of all, can I add this next position without exposing myself even more to a specific cluster? And secondly, if you are in an over correlated position, what do you do about it? So those in practical terms are the 2 questions you need to bear in mind. So book level versus trade level risk. What do I lose if this stop is hit is how we look at it with trade level risk. And then with a book risk or portfolio risk, if the US dollar rallies 100% overnight, what happens to my account? This is the stress question. So essentially, if you can forward think this, and we're actually developing something right now that is going to enable us to do that. So the idea is that you would paste in, it's going to be on a web page, so you would paste in just a screenshot, just a snip of what you've got open at the moment, and it will work out the correlation exposure. It's based on a tool, if I can find it. Let me just see if I can find it very quickly. Okay, So I'm going to just flick you over to MT5 if I can. Right. So on the screen, you should see the correlation exposure monitor. So what this does is it splits it into different clusters. In this case, you've got 7 on here, and then looks at the equity level, decides what the concentration is in particular clusters, and then makes a decision whether it's okay or not. And then we can type in, let's say we typed in NASDAQ 100, and we're going to buy 6 lots. We can check and see what that happens. And what this would say is that this would increase our risk on exposure significantly, which would put us into a tricky position. So what we might do is we might reduce the size, and this says caution, and say, so what we do again is check. It still doesn't like it at all. So this gives us an idea about, so there you go. This gives us an idea on the basis of this risk on correlation, risk on concentration, as to whether we're in a good place or not. These are EAs that are sort of open at the moment and the clusters that they're assigned to. Hope that makes sense. So what we're doing is we're taking this principle, for those of you part of MT5, if you fancy that, just drop me a line, I'll tell you how to get hold of it. But this is going to be online. So what you're going to be able to do is actually plonk in, as I said, a screenshot, and the maths behind this will enable you to do exactly what I've done, but on a web page. How does that sound? Okay, so what we'll do now is let's pop it back to our slideshow presentation. There we go. So what we're trying to do with the Sentinel mindset is watch the whole perimeter, not just one gate. So does this change the safety of our portfolio? Or so rather than is this a good setup, we're asking the question, does my book have room for this? Now, there's other things we can integrate within this Sentinel idea, but the bottom line with this basic question is that both answers should be yes. So you want a good setup, of course, that is important. We want every trade you look at to be a good setup. We want it to take into account some of the things we've talked about. We want your exits to be great. So the 2 videos that are already posted should help you along with that. And then we ask, before we press the entry button, we do a question that, does my book have room for this? So if you like, the pre-trade portfolio or book check should have essentially 4 questions. Does this correlate with anything I hold? Does it add to an existing directional theme, i.e. risk on, risk off? What's my total exposure to this currency or asset after entry? And if my dominant theme fails, because invariably you do, because of the way markets are, you want to position yourself in the way that markets are going at any stage. What's my worst case drawdown? That stress test that says this is my worst case scenario. And we've also got something that calculates that as well. So again, that is going to be part of the overall Sentinel picture. So it only should take you 60 seconds. Once you start to think in this way and you familiarize yourself with the cluster concept, that's all it'll take. 60 seconds to tick, 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 tick down these 4 things. And you do it every time, no exceptions. And what that does is it prevents those seriously significant drawdowns you'll get from an adverse market move. That's the aim of the game. Whilst, of course, having a dominant theme allows you to take advantage of what the underlying market has. Now, other things that would be in such a Sentinel would be a market shock protection or notification. Perhaps a look at how markets are coiling right now to see if whatever dominant theme is in play now that you've pitched your positions on, whether that looks as though it's beginning to change or otherwise. Is there underlying market economics or macro factors that say the market's not actually following the current headlines, but might well choose to do so? So all of these things are part of the Sentinel, overall Sentinel concept. But if you can master this, this is probably your number 1 for right here, right now. Everything else is responsive in terms of markets are changing, let me know. So you need to keep an eye out for that. And of course, those a couple of you have been looking at Mastermind, and those of you who are part of that, we're going to be doing some work, particularly on the shock side of things, as one of the parts of Sentinel, as well as this the correlation stuff in terms of how you're actually positioned. So those two things are part of that game. So essentially what you've got, as I said right at the start, there's no point in talking about this unless we give it some practical application. So there's 4 decisions in practice that you're making. Number 1, sometimes the best trade is no trade. The setup is fine, the book is full in terms of its exposure to one particular cluster, and skipping it is a decision. It's an active decision, not a miss. So it's not that you've missed a trade, it's that you've chosen not to enter a trade because of it. Now you can still track it, of course, and maybe that's good to do in terms of making sure, okay, there's another tool we've got for MT5 which actually allows you to record all the trades you chose not to take, puts them all in a CSV file, and then there's a little script that analyzes it later on. But sometimes, and we're going to talk a little bit about this in the next session, about the sitting on your hands. Decision 2 is, do we trim to make room? So it might be that we reduce or remove an existing position because it looks as though it might have done what it was intended to do, to enter a better idea, one that's just showing that it's setting up. So although our exposure doesn't change, what it says is we can't take another one on board right now, maybe, or maybe it's not wise to do so. But if we removed one position which looks as though it's starting to fail, maybe that's okay. Now, if you are to do that, if you're exiting prematurely according to your plan, again, it's worthwhile recording that in your journal or whatever you use to record your trading decisions, so you can sort of mark it as a variant. Decision 3 is, maybe you do still like the trade, and maybe the underlying market is suggesting that all is still good, but it's going to take your position into one of those caution. You see, when I did that correlation exposure MT5 indicator, that there was essentially 3 levels. There was it's okay, it's caution, and don't do it. So a caution may be assigned to say, right, we're going to half size that trade and we're going to accumulate it if we trim another to make room later on. And decision 4 is, obviously we can take profit on the book. We don't just look at each individual trade when things go well. Again, we should look at the portfolio. If we have a specific trading idea that's gone very well and it's all gone into our favor with the directional positioning that we've or the dominant position that we've taken, then banking that theme or part of that theme to say, yeah, that's great, we've got it, we've locked this into our account, and then we'll sort of press the reset button with the positions that we've got left and restart the process again of making sure that we're balanced as we go. So in practical terms, those are the 4 decisions to make. So when you look at your portfolio as a whole, you first of all make a judgment into where it is now. If it's in a good place and it is still a good trade, then you don't have to do any of the other things. This is essentially what happens when you find you're edging closer to a potentially unhealthy correlated state. So if we look at common book failures, just to reiterate these: the conviction cluster, so 5 versions of the one idea, diversification in name only, but essentially the market moves overall in one direction, that all your positions are going to move in one direction. Watch out for the revenge stack. So if your theme loses, you add more of the same theme to try and win it back. Another portfolio failure, and worth bearing in mind, is the invisible hedge. It's all very well being diversified, but it is healthy to have a dominant theme based on underlying market conditions as well, to take advantage of the opportunity. If you have positions that cancel each other out, essentially, then you could be paying spread on zero net positions. So keep an eye on inadvertent hedging, and then, as I said, look at event risk across the book. There's no, on a day-to-day basis, there is no bigger risk than significant market events. Now, most of these, fortunately, are planned, so we can plan for a CPI or a interest rate decision or an on-farm payrolls. This will hit every position at once, and so as you're coming up to that, then obviously you can take action in terms of reducing your positions, or even sort of things like tightening stops or partial closing. So what we've talked about today is primarily number one, which is the conviction cluster, but don't forget the others as well, because they are important at specific times. Some, like the invisible hedge, is worthwhile keeping an eye on as well, but the event risk is worthwhile, whether trading automated EAs or whether trading on a discretionary basis, as most of you are, then that's often worth a look. Now, of course, with many of you based in Australia, the tricky bit is, of course, that most of those major events come in the US. So putting some things in like exit-only EAs, which we'll talk about in the last session, or utilizing MetaTrader's trading stop is worthwhile putting it in place for those occasions, of course. So just a live walkthrough, just to, if we look at this sample book, what we're going to do is we're going to have a look. 4 of the 5 sit in one cluster. So the short USD risk on, which is that one, and that one, and that one, and that one. So the net currency exposure, the real USD position, is net short USD times 5. So every position wins only if the USD falls, and the other case, of course, is equally, or the other variation. Every position will lose if the US dollar gains. So if we run the stress question, if the USD rallies 1% overnight, all 5 will lose together. So if you've got 1% risk on each, you're going to be down 5%. If you've got 2%, 10%. And then can I add the next one? Well, no, the book is already overloaded with a single idea. That is essentially what you'll do, but you need to just do a little bit of learning. And as I said, what I've tried to do is put you together a handout which may help. So let's just have a quick look at the tool, if I can sort of find it. If you give me a second, just again to reorganize my screens. So what I've done is, if I just try and share this now, if you give me a second. Here we go. So this is going to be your download from today. As I said, I'll put it in the Discord channel. So you've got it. So once you've done this a few times, I think it'll start to lock in. So list your book, every position, no exceptions. And what I've done is I put a cluster reference here. And then there's some questions, net it out, what you're really long or short. And then the 4 questions. Does it correlate with anything I hold? Does it add to an existing directional theme? What's my total exposure after entry? And if my dominant theme fails, what's the worst case drawdown? And can you live with it? Yes or no? And then can I add the next one? So just be aware, put some red flags in there, 3 or more positions in the same cluster. A stress question you can't live with if it's a no, and obviously adding to a theme that's currently losing is possibly not the good way to go either. So hopefully those will help a bit along with what we've covered today. So just keep an eye out for Sentinel. I'm just going to pop it back to the presentation for Sentinel developments. For that correlation exposure, if you want access to that, drop me a line. And of course, we can sort of take on. If you take this on, it'll make you overall a safer trader. As I said, if you trade stocks and stocks alone, exactly the same concept, but think in terms of sectors rather than to the same degree clusters. And within that, not just sectors, but whether within some sectors there's defensive stocks or growth stocks as well as value stocks. So make sure you take that into account as well. That's really important. But it's the same process. And if you're AI familiar, you could take that tool that I've developed and put it in there and say, can you adapt this for a shares context? So if you, as I said, if you look in the Discord channel, you'll see the 2 that the 2 videos that I'm going to well along with the tools for that. Day 3, you'll get the recording for this, and of course that tool I've talked about. So what I want you to do, well, 24 hours is a bit of an ask. Let's say 48 hours. So run the self-assessment on what you've got open at the minute. Identify your biggest single hidden concentration. As I said, this is a habit thing. And don't forget that if you're running more than one account, you need to take the whole into account. If you're running EAs alongside discretionary trades, you've got to include them, their positions too, and the same assessment applies. And as I said, with a couple of things that can help, and of course something else coming soon. Once we get that whole Sentinel package online, it'll mean that you're fully aware of everything going on simply through the snip and paste of your current positions in your account. It'll just do the maths on that and then spit out some ideas. So hopefully in the not too distant future, you'll have something that enables you to, so you don't do the maths, that will do exactly what that correlation exposure thing did for you. And then of course, tomorrow we've got Sit on Your Hands, so I'm going to do a quick video on that. We talked through this session, we referenced sometimes it's a good thing not to take a trade, and we'll talk about that in a little more detail, the reasons for that, why it's so difficult, and a practical ABC guide to making sure that you're in a better place to be able to do that. So I think along the way I probably answered your questions, but I'm just going to check. Yeah, Michael, I don't like this new GoToWebinar. I'm going to so if you go back into Discord and just have a look in your direct messages, there may be an invite sitting there. If not, so when you communicated with me, so you've been added to one of the channels. Let me just double check that when I get back, but I did action that today once I'd caught up with posting the video. So hopefully that'll be resolved for you. If not, we'll work it together through direct messaging. Discord seems to have changed the way people access stuff, but hopefully we've got that sorted. Just, yeah, if you go into your direct messages with me, you'll see a little invite there that says go to server. So if you click on that, that should put you in the server, and I'll manually add you to the channels if they don't come up automatically. And what I'll do is I'll send you a, likewise with the rest of you, if the rest of you are already in the, then if you can't see them, first step is to go up to that browse channels. Go to the browse channels in the top on the left hand side bar, right up to the top, and tick anything that needs to be ticked. So that's all you guys who are still in there. All right, I think that's everything answered. Thanks, guys. That's great to see you here, and thank you very much for being part of this. And give me feedback in terms of how useful it is, what's useful, what's not useful. I've tried to put it at a level which will have something practical for everybody to have a look at, irrespective of whether you're very experienced or still finding your feet or getting back in the saddle, wherever you are. So I think I'm hoping that I've hit the right mark with this. So yeah, so all of you, there's a channel per day, so you won't miss out on anything. Better just check actually. Let me do it. Just one last check that I've made sure that there's one more setting. I just need to make sure that everybody can see and read previous messages. Otherwise, you won't be able to see anything. That's all good. That's all good. So you should see anything that's been posted before, and they're there for you for whenever you need to or want to have a look at them. So, and of course, there's a couple of bits of homework relating to each. There we go, ladies and gentlemen. Okay, so as I said, tomorrow's day 4. There's a video to watch, or there will be a video to watch and some homework to do, and this will be a sort of checklist type thing. So it's not going to go away. So this is the sort of thing I want you to be able to access at any time you want to. So you'll be able to put back in and out over the weeks and months as you put things in place, and so to balance everything else that's going on in your world. So there you go. Anyway, that's it for today. Thank you very much for being here. I'll post the recording as soon as it's cooked. And I look forward to seeing you in Discord and, of course, at the next session, which I think is Wednesday at 7 o'clock again. Okay, you guys take care of yourselves. Enjoy the rest of the evening, as I might see some of you on the all groups EA session. So we'll catch you there. And we'll catch you very soon. Thank you very much. See you soon.